Hello friends, this is Professor Amarjeet Kaur. I am working with the Department of Management at Gurugram University, Gurugram. It has been a while that I have been working in the industry for almost 34 years now. So, it's my privilege that I am here with you to talk about leverage. So, this is the topic we have discussed in the past as well. This is part 2 I am going to cover today. So, in part 2 we are going to talk about financial leverage and combined leverage. That would be the agenda for next 30 minutes. So, I wish you to be with me, stay with me and learn about leverage. So, friends, leverage has to do with how do company, how do a company, how do a business or how does a business actually think about the employment of fixed cost in the financing and operating aspect of business. So, how does a business or how do companies take up the fixed cost existence of fixed bearing securities or fixed monthly expenses, fixed operating expenses in the business. So, deployment of these fixed things, that has to do with the leverage. So, accordingly, if companies do deploy fixed operating cost, means salaries, rental every month, etc., etc., it is known as fixed operating cost, and the leverage which it affects or which it belongs to is operating leverage, which has been discussed in the past, and if you are keen to learn about that, you can refer to leverage part 1. And today in this section, we are going to talk about the effect of employment of fixed interest bearing securities. Fixed interest bearing securities, where would they be employed in? They would be employed in the capital structure, right. So, deployment of fixed interest bearing security means what? Debt. Debt, either a term loan, project loan, debenture, bonds, etc. You may name anything, but actually we are deploying any security where we have to pay a fixed interest amount, and that is where the financial leverage comes into picture. And if we want to study the impact of both operating leverage and financial leverage together, that how much does it affect the earning per share of a shareholder in a company, then it is known as combined leverage. So, we will discuss these two concepts in today's topic in detail. So, let us talk about the financial leverage first. The leverage associated with financing activity is called financial leverage. The financial leverage exists if there is a use of funds bearing fixed financial payments like debt, right. So, fixed bearing funds are used. Financial leverage is measure of financial risk. The operating leverage, which has been discussed in the previous part in the past, there we see how much is the operating risk for a business, being not able to pay the operating expenses. In the financial risk, we are measuring how much is the financial risk. Financial risk means being not able to pay for the financial obligations, be it interest on the loans, be it the principal money. So, company is not able to pay the financial obligation or meet up the financial obligation. So, that is what we measure. If company employs financial leverage, company is at a financial risk. Higher the financial leverage, higher is the financial risk. Lower the financial leverage, lower is the financial risk. Very much like operating leverage, financial risk is also something which is a two-sided sword, which means in the rising time it affects positively, substantially, and in the declining times, at the time when the sales are declining, it affects negatively and then again substantially. So, financial leverage is defined as the tendency of residual net income to vary, to change disproportionately with operating profits. So, if my residual income is earning per share, right, how my earning per share will change if my operating profit EBIT is changing. So, this indicates the change in taxable income as a result of change in operating income. So, taxable income changes, right? Earning available to shareholders changes because of the changes in operating income. So, how much, how does it affect, how much does it affect will depend upon what is the value of financial leverage for the company. So, that is how the financial leverage matters. So, it's the ability of a firm to use fixed financial charges to magnify the effect of changes in EBIT, because as I said, leverage is always taken as a magnifying instrument in any financial structure or in any operating level structure. Very much like we have lever in machines, lever in our wristwatches, in our clocks. Same way, the leverage has come from the lever, the term lever. So, as the lever accelerates the function, same way leverage accelerates the function of the business operations and affects the earning per share or affects the EBIT accordingly. It means the percentage change in earning per share, which is occurring because of the percentage change in EBIT, is actually measured as the degree of financial leverage for a business. That is what the financial leverage is. So, if there is no preference dividend, then how do we calculate it? Because a business may have debt, equity and preference all together, all the three type of sources of fund, because preference is a hybrid source, as we all understand. Equity is shareholders fund, owners fund, and debt is a loan amount. So, if there is no preference dividend, how do we calculate financial leverage? In that case, financial leverage will be equal to EBIT, earning before interest and tax, divided by EBT, earning before tax, right. So, that is what is the calculation of financial leverage. What is earning before tax can be calculated by earning before interest and tax is basically your sales minus variable cost minus fixed cost, and your and the P is preference dividend, and your 1 minus T is the tax paid, and then F is the fixed cost, and Q into S minus V is basically contribution. So, contribution minus fixed cost minus dividend preference, that is if the preference dividend is there. Since in this formula we are assuming no preference dividend, we are assuming so it means the preference dividend is constant, there is no preference dividend, earning per share would be V into the quantity sold into S minus V, which is contribution margin, and then multiplied by 1 minus tax, the whole divided by n number of share existing, that gives you earning per share. So, this is when then there is no preference dividend. So, the other way around, when there is a preference dividend, in that case the formula would be, degree of financial leverage would be EBIT divided by EBT. Remember, in the previous formula it was EBIT divided by EBT when there is no preference dividend. But if there is a preference dividend, here in the denominator we have EBT minus the preference dividend, which is divided by 1 minus T, the tax rate. So, degree of financial leverage changes because of the preference dividend paid, and the tax effect is also taken into consideration. So, EBIT divided by EBT minus preference dividend divided by 1 minus T, that is the formula for financial leverage. Now, the same thing can be further calculated when we want to calculate degree of financial leverage. Degree of financial leverage would be percentage change in taxable income, which is EBIT divided by percentage change in operating income, right. Taxable income which is available to shareholders for distribution basically. So, EPS. So, this is another way to define it, the percentage change in EPS divided by percentage change in EBIT. So, both are going to lead to the same calculation. The second formula, percentage change in EPS means delta. It means what was the, so how do we calculate percentage change in EPS? The delta EPS means current year minus previous year is delta, and then divided by the previous year EPS. That will give you percentage change. This is a basic maths. We need not to talk about that. Same way, percentage change in EBIT means change in EBIT of 2 years, year 1 and year 2, divided by EBIT of previous year. That will give you percentage change in EBIT. So, percentage change of EPS is divided by percentage change of EBIT, and that will lead to calculation of degree of financial leverage. So, I hope these formulas are clear to you. We shall be talking about few small example to understand how financial leverage work actually, right. But just be sure about the fact that we are understanding how the earning per share means the earnings available to equity shareholders are affected by EBIT. In the operating leverage, we were seeing how my EBIT is changing because of change in sales, right. Here we are saying how EPS is changing because of change in EBIT. So, getting the difference between the two, and as I said, combined leverage will be product of two. So, ultimately in combined leverage we will see how earning per share they change because of the change in sale, because EBIT gets striked off in both the formulas. So, how EPS would change in because of change in sales will be discussed in the combined leverage, but I am trying to connect the dots here so that you are able to relate this when I discuss combined leverage later. Okay. So, let us take up the example to understand the functioning of financial leverage. Contribution margin is 20,000, fixed cost is 15,000, 10% debt is there in the structure of the company. Find out financial leverage. So, here we have to find out the financial leverage FL. It would be EBIT divided by EBT. So, what is EBIT? EBIT is your contribution margin less your earning before interest less fixed cost. So, what is the fixed cost? 15,000. So, 20,000 minus 15,000. So, EBIT becomes 5,000. So, in the numerator we have 5,000. In the solution you can see that, divided by denominator EBT. What is EBT? Earning before taxes, not before interest. So, earning before interest and taxes was 5,000, and the interest is your 10% on 37,500 means 3,750 would be interest. So, earning before tax means after interest would be 5,000, which was EBIT, less the interest 10% on 37,500 means 3,750. So, becomes 1,250. So, EBT becomes 1,250, EBIT is your 5,000. So, if you divide 5,000 with 1,250, it gives you answer 4, right. So, how would you interpret that? That is the question. Think about it. How would you interpret this value 4? Calculation is fine. Calculation could be not that difficult even, because a small formula you may remember and you can calculate. But my question is, how would you use this E4 as a to explain to anybody about the financial leverage. This 4 value of financial leverage says, if my EBIT, earning before interest and tax, change by 1%, my earning per share would change by 4%. So, it is a magnifying effect, as I said. It magnifies the function, it accelerates the function. So, which function we are talking now? We are talking about change in EBIT causing change in EPS. So, such a huge change, 4%, 1% vis-a-vis 4% means how much effect can you imagine? How much change it is actually, such a high change. Why? Because there is a very high amount of debt funding being used. Higher the debt funding, higher would be leverage. There could be leverage of 8, there could be leverage of 1 for another company, right. Company with 1 leverage is at a less risk of less financial risk versus the company which has 8 financial leverage. That company would have 8 times more financial risk than the company having only one value or one answer as a leverage, financial leverage, right. So, that was the interpretation of the previous question. So, I shall be taking one more question or two more small questions to help you understand this, how degree of operating leverage can be calculated. So, here in this example, we have decrease in EPS 75%, we have decrease in operating income 66.66%, calculate the financial leverage. So, it is a very direct question where we have been given the delta, the change, the decrease in EPS, the change in EPS as well as change in operating income, the both are negative. So, change in EPS 75% divided by change in operating income 66.67%, answer comes out 1.25. So, company has a risk of 1.2. So, if there is a change in your EBIT, the EPS would change only by 1.25%, not very high degree of operating leverage for this company. So, this is how we interpret the degree of operating leverage. I shall be taking one more question before I discuss about combined leverage. So, here in this example, we have installed capacity of 20,000 units for a company. The actual production and sales is 75% of installed capacity. Selling price per unit is 10 rupees, variable cost is 60%. Degree of operating leverage is 2. 10% debt is given for 1 lakh rupees and 15% preference shares are also given of 20,000. Tax rate is 40%. Find out the financial leverage. So, it is interesting, yeah. We have been given degree of operating leverage 2. Degree of operating leverage is what? Degree of operating leverage is basically contribution margin divided by EBIT. If you remember, if you have seen the previous part, then it is contribution margin by EBIT, but otherwise I can let you know at this moment the degree of operating leverage is contribution margin by EBIT. So, in this case what is happening? It is a little interesting case. The capacity of the company to produce is 20,000 units. Instead of 20,000, company is producing or company is working at 75% capacity, means 15,000. So, company is producing 15,000 units and the price it is selling at is 10. It means the total sales are 15,000 units multiplied by 10 means 1,50,000 rupees, right. And then variable cost is 60%. So, 60% of 1,50,000 means 90,000, right. So, my contribution becomes 1,50,000 sales minus variable cost of 90,000. So, it becomes 60,000. Got it? So, degree of operating leverage is 2. So, EBIT contribution margin divided by EBIT is equal to 2. So, contribution margin is 60,000. So, 2 is equal to 60,000 divided by EBIT. For EBIT we need to subtract the fixed cost as well. And how much is the fixed cost? Fixed cost is given. So, if you subtract the fixed cost from the contribution margin, it gives you the EBIT. So, accordingly by calculating this, we get 30,000 as your the amount of EBIT. So, EBIT, because you take 2 on the other side, 2 is equal to 60,000 divided by EBIT. EBIT is not given. How will you calculate EBIT? Either CM minus fixed cost, which is not given in this example in this case, right. So, what we will do? 2 is equal to 60,000 divided by EBIT. So, if you interpolate, EBIT is equal to 60,000 divided by 2. So, answer comes out to be 30,000. So, that is how you see 30,000 is the EBIT. EBIT divided by what? EBIT divided by EBT. What is EBT? EBT is what? EBIT minus interest. Interest is how much? That we have debt funding given in the case. So, debt funding is 10% of 1 lakh, which means 10,000. So, 30,000 EBIT less 10,000, it becomes 20,000. So, EBT 20,000 divided by minus preference dividend divided by 1 minus t. What is the preference dividend? It is clearly showing the preference share capital is 20,000 and 15% is the dividend, means 3,000. So, that is why you see here 3,000. So, 3,000 divided by 1 minus tax, tax is 40%. So, 1 minus 0.40 means 0.60. Okay. So, that is how it is 20,000 minus preference dividend of 3,000 divided by 1 minus t, which is 0.6. So, if you calculate this, it becomes 30,000 divided by 15,000. So, the leverage comes out to be 2. So, this was good case because we have operating leverage being given, we do not have the fixed cost in the structure given straight away, we have to calculate it indirectly. We need to know the formula of operating leverage to calculate EBIT, which we did here in this example which I have discussed. When we have the tax rate given, we have the preference dividend given. So, we used the formula, if you see this one in this solving this case. This was the formula which we solved, which we used to solve the degree of financial leverage, EBIT divided by EBT less preference dividend divided by 1 minus t, right. So, EBIT we calculated by using the operating leverage, the value of operating leverage. Then EBIT we calculated by subtracting interest from EBIT, 30,000 minus 10,000, that gives you 20,000 EBT, preference dividend 3,000 divided by 1 minus t, t was 40%. So, it becomes 0.6. That is how we reach to the calculations. Okay. So, 2 is the answer for this particular case study. So, now times comes to talk about combined leverage. So, what is combined leverage? The combined leverage, it actually measures the effect of change in sale over earning per share. So, it is a concern when company is using both fixed operating cost as well as fixed financial cost, right. There is a debt funding in the financial structure and there is fixed operating cost, which is generally true for almost every company. Every company, most of the companies, I hardly come across a company where do not have fixed operating cost. It could be question of more or less, but most of the companies would have fixed operating cost. So, this is concerned with the firm's capacity to meet its fixed cost, both operating and financial. When we are trying to find out the combined leverage, we are actually trying to see the relationship between revenue on the account of sales and the taxable income, which we measure, which we equate with earning per share. So, combined leverage is can be measured again 2 ways. One is contribution margin divided by your PBT or EBIT, profit before interest and tax, and profit before tax but after interest, or it could be EBIT, both ways. And degree of combined leverage, if I want to calculate, is percentage change in earning per share divided by percentage change in sales, right. So, if you see, it is actually the combined, it is the product of both financial and operating leverage. So, this is ultimate leverage, which is discussing the total effect of operating cost having fixed part in it and financial cost having fixed part in it. So, it is called degree of combined leverage. So, see here in this slide we have degree of combined leverage. The first part, contribution divided by EBIT, is operating leverage and multiplied by EBIT divided by EBT, which is financial leverage. So, EBIT gets striked off with EBIT. So, it is equal to contribution divided by EBIT, right. So, that is how contribution by EBT or PBT, you can call anything, is the method for calculation of combined leverage. So, now we shall be taking a small question and then we will stop discussion. The same question which we discussed previously, right, we solved a few minutes ago. Here we calculated operating leverage is given 2 and we calculated financial leverage, which came out to be 2. As I said, combined leverage is the product of operating leverage and financial leverage. So, it comes 2 into 2, 4. So, this is the same case which I discussed for financial leverage. There is no change, but now from the same case we are calculating combined leverage as well, right. So, here it says find out the combined leverage, CL, compound leverage. So, the operating leverage is already given in the formula. We, with the help of operating leverage, we calculated actually EBIT, right, and then we calculated EBIT, and then we calculated EBT, we calculated, you know, we considered preference dividend, we considered tax effect, and we calculated the financial leverage of 2. So, we multiply both of them together, then it comes to the you know, degree of operating leverage as well as degree of financial leverage. Multiply both of them and you get the answer of combined leverage. So, friends, I would like to conclude by saying the high financial leverage plus low operating leverage is the excellent, right. An ideal situation could be to maximize the profit with the minimum risk, where there is a low financial leverage and high operating leverage. It could be good. If both of them are high, it is a very dangerous situation. So, companies needed to be very careful in designing their cost structures and their financial structure. So, with this I would like to wind up now. Thank you very much being with me. Thank you.